This is Covered Calls with Kevin Simpson, featuring expert insights and analysis from the industry's top investment professionals. If you'd like a deeper understanding of today's markets, this is the show for you.
Welcome to Covered Calls, our podcast where we try to bring enlightened speakers in the world of finance. And today we are so lucky to have Rob Sechan joining us. Rob is the CEO, managing partner, and co-founder of NewEdge Capital Group. Rob, thank you so much for joining us.
You're welcome. It's great to be here, Kevin.
You always look like $1 million. It's humbling to have to sit next to you, but thank you.
I don't know about that.
Now, listen, our audience, Rob, is primarily financial advisors. We've got great financial advisors around the country who tune in, and some of them might not be as familiar with NewEdge. Could you give us a little background on it? I know in 2022, Barron's named NewEdge in the top 100 RIAs, but I know there's still a lot of financial advisors out there that might not have a great familiarity with the firm. Tell us about NewEdge.
Yeah, so like your audience, it sounds like, NewEdge was a firm built by a financial advisor for financial advisors. I mean, I spent my entire career as a financial advisor, and like most of your audience, I'm sure, trying to drive better outcomes for clients. And I thought the best way to drive better outcomes was in an independent setting. But because I always worked at a big bank, I was used to having a depth of resources at my disposal to help cover clients. And that worked for a long time. I mean, I started my career at Morgan Stanley. It was a wonderful place to be back in the days of Byron Wien, Barton Biggs, and Steve Roach. And it was culturally one of the greatest places in the world. I felt like when I walked into a meeting, I felt like a young Superman, because I could brandish that firm on the front of my jersey, and I played better and kind of played above the rim. That was very important to me, to have a depth of institutional talent to be able to provide advice, and people wanted to affiliate with that ecosystem. I then went on to Lehman Brothers, which was a great experience for me as well. I know a lot of people might say that theirs wasn't as great as mine was, but also very culturally significant. What I loved about Lehman is they wanted to grow, they wanted to win, and when you were at a place like that, that momentum was a rising tide that lifted all ships. Obviously, Lehman failed in the midst of the financial crisis, and that was hard for everybody involved, all clients, employees, and obviously the senior leadership at the company. And when Titanic hit the iceberg, my Carpathia was UBS. So then I went to UBS, and I think I built a very nice business advising significant clients of the firm, really in the ultra high net worth space. But throughout my progression there, I started to realize that my clients wanted more than they could get at UBS. And the notion of one firm being the central resource for them was not something that appealed to them, and it's not something that I really believed was in their best interest. So I began to explore the notion of independence, and independence, kind of checks all the boxes. You move to the same side of the table as your client, and you can do that at a big firm, but it's much harder, because when you're at a big firm, you have a heavily curated set of resources. And I just wanted to consume everything that was great out there from my clients. And you just couldn't do that. And so I began the process of exploring independence. What I quickly noticed was that there weren't a lot of firms out there that had the resources that I was used to and the resources that were required to give clients great advice. And so at some point along that continuum, I decided to build that firm. And what was that firm going to be? It was going to be a firm that drove better outcomes for clients by using the most disruptive force in the world today, which is financial technology to drive better price, better execution, more informed decision making from a portfolio construction standpoint, better risk management decisions. A lot of the big firms have even moved to quant in managing portfolios, and we certainly embrace that philosophy too. And then obviously organizing assets, because no one firm has a monopoly on great ideas. And so being able to see what people have everywhere and give them advice holistically was important. But more than that, we had to stack up a resource set, an intellectual capital set in two verticals, Kevin. Wealth strategy, which is a human capital thing, right? It's tax specialists, it's trust and estate attorneys, it's structuring experts, it's the legal advice and structuring advice that marries with the client's long-term goals and objectives, so they can tax efficiently get there, so they can structurally efficiently get there. And then we hired some of the best and brightest people in the industry. I'm fortunate to have been backed by an institutional investor. EdgeCo is the parent company. EdgeCo is today, with our assets, $160 billion AUA business. And they are backed by two institutional investors, Parthenon Capital and Waterfall. And having that expertise in-house as we set out to build what we built was really special, but it also gave us the economic ammunition to hire very talented people, some of which you see on TV all the time, like Cameron Dawson and Ben Emmons, and they're visible, but a lot of others who aren't as visible as they are, and marry that with the technology, marry that with the strategy, marry that with the platform. And then because of our size and scale, I mean, NewEdge is a $36 billion RIA and RIA enablement platform. We launched in November of 2020. So to give you some sense for the progression that we've had, we're very proud of the ranking you mentioned. We're number, I think, 15 on Forbes and number 29 on Barron's in our first year.
That's amazing.
In participating in that. And so when you're as big as we are and you kind of have the brand momentum we have this access, to great firms like yours, but also to the big banks. They pay attention to us. And so the rationale for the story was to drive better outcomes, but why we created it, we felt it didn't exist. And so we are a heavily institutionally resourced and caliber firm that, I would argue is more resourced than any of the private banks out there, and a consumer of everything that's great for clients.
It's a great story, and I think I know the answer to this question in advance, but is there anything that you miss from the wirehouse side, from the larger companies?
At this point, no. I miss some of my old friends, right?
Yeah.
That is, and some of my old colleagues that, I thought were really difference makers in my career in life, and how I, formed this view. The good news is my partners came with and started this business with me, and we made a whole host of new friends that share the same ethos that we do, same vision that we do, and we're really rowing on the oars hard and building something distinguished and special. And again, it's all about clients. Advisors are client oriented.
Yeah.
So if they find something that works better for their clients, that's a win-win, right? And I think we've provided that ecosystem that is so virtuous that it's also led to far above industry growth for the advisors that join us. So they're seeing enormous success.
It's a great story. You mentioned some of the exposure on CNBC, and certainly all of our viewers are very accustomed to seeing you on Halftime with Scott. And have you found that you and your colleagues who are getting exposure there is good for business?
100%. Listen, you get bits and pieces of opportunity to communicate a message. And if your message is one of consistency, I think that's appealing to clients. And so I think we've been pretty consistent and thoughtful. We've been a little wrong on markets and being cautious, but it hasn't hurt any of the performance of the things we do, because we have such a quality focus, and I know you do too, in the way that we build portfolios, that clients have had one of the best years ever here at NewEdge. And I think they're incredibly happy with the result. despite the fact that we've approached it with caution for, I think, very good reasons, by the way. But
I mean, let's stay there, because I tend to look at the macro picture the same way that you do, the same way that Cameron does. And I don't think it's ever a need to apologize for being cautious and conservative. Our job, number one, is to not lose money, kind of protect what we've got. Your firm, it sounds like, deals with the ultra high net worth. They're not in the position where they necessarily need to make the most money. They need to not lose the most money. And that's the essence of true portfolio management. And I look at valuations here, and I think, it's difficult to, granted, there's momentum behind this market and you can push it higher if you want to, but from a true valuation standpoint, when you're looking at things from a fundamental basis, we're pretty close to fair value. So I don't believe that you've gotten the call wrong by any means. And I share your take on the markets.
Yeah, it's interesting. The entirety of the gains year to date have come from multiple expansion.
Yep.
Earnings estimates for both the current year and next year have been revised lower. And we're trading at 19 times. We're back to pre-pandemic peak in the S&P. And recall that at that time was supported by incredibly easy monetary policy. And unless we enter a new valuation paradigm, possibly based on optimism about the step change higher from EPS and in technology, we see little upside to current valuations, right? So it's hard. On the downside, I mean, if we went to a 15.5 time, just like we saw in June and October of last year, that means that you have to ask yourself, is the juice worth the squeeze? And, valuations are historically stretched in NASDAQ growth stocks. I think, one of the things that we saw early in the year is that the technology stocks were supported by the brief blip that we saw with the regional banking crisis. And so interest rates fell, and tech stocks took off, and then they got another leg higher with this AI enthusiasm, and yet we haven't seen that it work its way through earnings. And so in the short run, if we don't have a recession, though, I think the current environment can persist, because you have very high economic trajectory and earnings that are in revenues that are not supposed to keep up. And I'm willing to bet that you might see some upward revisions. Now, the weird part about that is it sows the seeds for difficult times kind of prospectively, and who knows when that begins. But ultimately, those headwinds, because economic forecasts are going to get revised up, as are possibly earnings forecasts, which are a little low, and that obviously makes things a little tougher, because it's not what actually happens; it's what happens relative to what was expected to happen. So I think those things are the reason we stay invested in quality, because we don't want to get caught out there. If there's this big re-rating in some of these high PE tech stocks, we don't want to be there. We're more okay with being in tech stocks that have all these trends in place that might be, and probably are, above their historical multiples, but not so exceedingly expensive. I think one of the great calls that we had was Meta at the beginning of the year along those same lines. It was a cheap stock with catalyzers that could benefit from this FANG enthusiasm. Right?
I remember you saying it. 100%.
Yeah.
You and Stephanie Link was also on that bandwagon at the beginning of the year. So congratulations on that call. I think people will always pay up for growth. When you look at the multiples, and I agree, there's massive multiple expansion that's taken place to bring this market up here. But unless you can get some earnings growth, you can't take the multiples to perpetuity. So if you're at 18.5 or 19 on forward numbers, it's hard to imagine an S&P that's going to be able to break through those highs of I guess maybe the first or second trading day of 2022, where we look into the future for next year and you say, well, where can they go? So for us, it's all about value also. But if you don't have 100% of your portfolio in NVIDIA or a Meta, clients wonder why, I'm sure. And if it's not in there, why is it?
Suffice it to say we don't, and sometimes they do. But I think the beauty of what we're seeing now, and I'm sure you notice it as well, is there's a broadening out in the market. So I mean, I think there is some, I don't want to call it value, but I call it relative value underneath the surface. And so the whole question is, does tech pause and allow some of these other things to catch up if we don't go into a recession, which is not our central case? And or do we see a re-rating of tech as we get to next year? It really takes a recession to have interest rates be where the Fed dots are telling us they may be in 24. I don't know that we can see the types of forward cuts that the markets are pricing in. And so there is some disconnect there. And it's why if you have these competitive moats that you have in your portfolio, we try to think about when we build our long-term core compounding portfolios, that you're going to be in a place that kind of wins either way.
Absolutely. Investing's easy, Rob. You buy companies that make money and pay dividends. You win in the end. Do you think the Fed's going to raise 2 more times?
We do. We think they're going to raise it the next in July, and then they'll probably raise 25 sometime in the fall. I think the Fed did get it right on inflation moving down. I don't know if it hits 2% by next year, but when you look at this core services ex shelter number, that's one of the biggest moderations we've seen all year, which is a good sign that the Fed has, at least some control in their policies are working in bringing prices down. They can't control quite energy or food as much, which is why they prioritize looking at the core measure. But the policy we think is close to restrictive enough to get a steady decline in inflation without causing a recession. So our call is they do tighten 2 more times. Our watch item is long-term inflation expectations, which still are above pre-pandemic levels. So it's a really interesting environment. It reminds me of what we talked about in February. The Fed seems to be on this very golden path, Kevin.
Yeah.
Which is, they're fortunate to be on. I'd say it was a Houdini act to make happen what's happened, but that has a lot to do with the lag effects, as you know, in the current environment that we're in. I mean, we've never seen. I don't know if you saw it this morning. Bridgewater came out with a piece that basically said why they were wrong, and I felt like I was reading our work, right? Which is on the markets, not wrong on investing, but wrong on the top-down strategy. You can be right on investing and wrong on your top-down strategy, and I think clients stay happy because they look at their statements and they're still pretty good. But we've never had an environment where interest rates have made this sort of climb and it didn't have economic implications. I think the impulse that's different this time is the period of hyper low interest rates. Rate suppression led to a lot of refinancing activity. And it's almost, as you know, made it impossible for people to move. Right, so they're spending a lot on their existing homes, and the impulse is not being felt in where it usually is felt, which is the housing market. It's going to start to be felt in autos and some of the other places a little earlier, which is why we've played this trade down kind of approach. And what I mean by that is people staying in their cars longer. So we own O'Reilly, we own AutoZone, we own a lot of these companies that are beneficiaries of a trade down, and have some really nice tailwinds as a result of just the structural dynamics that are different this time. But I can tell you that lag effects are just that. At some point, they catch up.
we live in a society where we want immediate gratitude, and patience isn't a virtue that many of us remember. But when you have a Fed that's trying to control something like this from an inflationary standpoint, you can't rush it, and it takes a long time. But it's working. And the Houdini comment, I mean, I couldn't agree with that more, because without the labor market, and to your point about housing, I mean, it would be just an impossible endeavor. So fingers are crossed. And if you're going to be wrong on a macro call, what a great time to be wrong. And to your point, we're all invested anyway, so we're not trying to time the market. And for those,
I think where advisors would struggle, and we certainly struggle, we've been fortunate to have a lot of success in winning clients, and our pace of deployment, may have been slower than some of them would have liked.
it's always better to be safe than sorry.
We agree.
We're up against it on time, but I can't tell you how much I enjoyed this conversation today. Tell our viewers where they can learn more about NewEdge, if they're potential investors, and if they're potential financial advisors who are exploring independence. I'm sure you would be more than happy to share your story.
Yeah. So our businesses are twofold. We have two wonderful businesses. One business is run by Alex Goss. He's my co-head of NewEdge Capital Group, Alex Goss and Neil Turner. And it's called NewEdge Advisors. And so really our powered by business. So for those that are interested in starting their own firms and using our chassis, we have one of the best chassis in the industry, and we can help you build that firm. We have 120 businesses that currently do that with us. So that's a wonderful business. And then for those that are more like me and want a fully resource stack, the access to the Camerons, the Rob Sechans, the Ben Emmons, the strategists that are all fully built out, we have the card carrying version of independence, which is NewEdge Wealth. And that's where I moved my practice to, is NewEdge Wealth, because I needed those resources. And, both are great places to be. You can find out about them on the respective websites, newedgewealth.com, newedgeadvisors.com. And it's a great place for you to learn about the notion of independence. I've also done some other podcasts with Mindy Diamond. So if somebody wants to hear, this, what the vision was at the onset, it's an older one, but it's one of those things that they can go to, take a listen, and see why we did all this, and why it's working so well. It was the right strategy.
Well, we're just thrilled about your success, and we know that it will continue. And thank you so much for your time today, and we'll look forward to having you back on again in the future.
Well, thank you so much for having me, Kevin, and thank you for being a great partner of ours too.
Thanks,
Rob. Great business, and you're a great PM.
Thanks, brother. We'll talk soon.
Talk to you.
This message does not constitute an offer to sell or a solicitation of an offer to purchase securities through CWP Advisory Services. Investments are not guaranteed and involves risk of loss. The views and opinions expressed in this message are those of investment professionals made at the time this content was recorded, are not necessarily the views and opinions of CWP, and may change in time without notification. For additional information about CWP, visit CWP's or the SEC's website for a copy of our ADV disclosure brochure and Form CRS.